Let's be honest. When was the last time you actually looked at your super account? Not just glanced at the balance, I mean really thought about it beyond the fact that it exists. If you're like most Australians, you probably picked a super fund when you got your first job, let your employer handle the rest, and haven't given it a second thought since. But here's the thing, your super isn't just a retirement fund, it's also a completely legal way to cut your tax bill. And most people don't even realize they can use it that way. So in this video, I'm gonna break down exactly how concessional and non-concessional contributions work, how to use salary sacrifice to reduce your taxable income, and how to take advantage of government incentives that could mean extra money in your super fund without doing much at all. Because if your super is just sitting there, you might as well make it work for you. Let's get into it. Okay, now let's start with the basics. There are two main types of contributions you make to your super fund, and they treated very differently when it comes to tax. The first is concessional contributions. These are made to your super fund before tax and include things like your employer's superannuation guarantee, which is the money your employer is legally required to pay into your super fund. Currently, the rate is 11.5% and it will go up to 12% on the 1st of July 2025. Salary sacrifice contributions, which we will talk about in the next section, and personal deductible contributions. This is if you're self-employed or you want to make extra contributions yourself, you can contribute yourself and then claim a tax deduction. The key thing to know about concessional contributions is that you are taxed at 15% inside your super fund instead of the marginal tax rate, which can be as high as 45% if you're a high income earner. The other type of contribution is also known as non-concessional contributions. Non-concessional contributions are an after-tax contribution, meaning they don't give you a tax deduction up front, but they can still be a valuable strategy, especially if you're looking to build wealth inside your super fund. The biggest advantage of non-concessional contributions is that once the money is inside super, it grows tax-free in retirement. If you invest outside of super, you normally pay a tax on investment earnings, but inside super, your money benefits from lower tax rates while you're working, or no tax at all once you retire and start drawing a pension. So non-concessional contributions can be useful for people who receive a windfall like an inheritance or a bonus and want to invest it tax effectively, those nearing retirement who want to boost their super balance before they stop working, high income earners who have maxed out their concessional contributions and want to put more into super, and those looking to purchase an investment in this SMSF and requiring more funds in the super fund. So which type of contribution should you use? Well, it depends on what you're wanting to achieve by making these extra contributions. If your goal is to reduce your tax bill today, concessional contributions are the way to go. Salary sacrifice and personal deductible contributions lower your taxable income and let you pay less tax upfront. If you have spare money and you want to invest tax effectively for the long term and reduce the tax you pay in the future, non-concessional contributions can be a great option. You won't get a tax deduction now, but you'll benefit from a tax-free investment growth in the future. Most people focus on concessional contributions first because they provide an immediate tax benefit. But as you start thinking more about retirement planning, non-concessional contributions can play an important role too. Now that you know how super contributions work, let's talk about strategies you can use to make the most of them. There are 4 key strategies that can help you take advantage of the tax efficient ways to contribute more to your super. The first is one I mentioned earlier, salary sacrifice. Salary sacrificing is one of the simplest ways to reduce your taxable income. Instead of taking all of your salary as cash in your bank account, you ask your employer to direct part of it into your super before tax is taken out. Because concessional contributions are taxed at 15% instead of your marginal tax rate, this can lead to immediate tax savings. For example, if you earn $80,000 per year and decide to salary sacrifice $10,000, that money will be taxed at 15% rather than the 30% tax rate you would otherwise pay. That means instead of paying $3,000 in tax on that $10,000, you only pay $1,500, saving you $1,500 in tax. At the same time, your super fund balances grows, and because those funds are invested, you're also benefiting from compounding it over time. Salary sacrifice works best for people who earn more than $135,000 per year, since that is where the tax savings start to make a real difference. You'll be saving over 20 to 30% in taxes. The key is to make sure you stay within concessional contributions cap, which includes both your employer's contributions and any contributions you make personally. The current cap is $30,000 $30,000 per year. So if your employer is contributing a significant amount already, you may need to check how much room you have left. The second strategy is relevant if you are self-employed or your employer does not offer salary sacrifice. With this strategy, you can still contribute extra to your super and claim a tax deduction. This is known as personal deductible contribution. The difference is that instead of having your employer direct the money into your super fund before tax, you contribute the money yourself and then claim a tax deduction when you do your tax return. The end result is the same. You lower your taxable income and your super balance grows. But this option gives you more flexibility. To claim the deduction, you must lodge a notice of intent to claim a deduction with your super fund before you submit your tax return. If you don't do this, you won't get to be able to claim the tax deduction. This strategy works well if you receive a bonus or unexpected income during the year. Instead of taking the full amount and paying tax on it, you can contribute some of it to super, claim a tax deduction, and keep more of your money working for you rather than the tax office. The third strategy is related to concessional contributions caps. As I mentioned earlier, you have a cap of $30,000. Not everyone can contribute the maximum concessional amount to their super each year. But if you have gone under the cap in previous years, you can essentially catch up. Carry forward concessional contributions allow you to use unused concessional contributions caps from the last 5 years to contribute more in a single year. This is useful if you had a lower income or financial commitments in previous years and did not contribute enough into your super. You have received a higher income this year and you want to offset your tax bill, or you want to make a large contributions without exceeding the cap. For example, if you only contributed $15,000 in concessional contributions last year instead of the full $30,000, you could carry forward the unused $15,000 and contribute it in the future, provided your super balance is under $500K. This strategy is most useful for business owners, freelancers, and professionals who experience fluctuating income from year to year. The last strategy specifically relates to non-concessional contributions, especially if your goal is generating passive income through investments. If you're planning to invest money to generate long-term passive income, placing those investments inside your super fund can be a tax-smart strategy. While it's true you won't get immediate tax deduction from making non-concessional contributions, what you would get is significantly lower tax rates on your future investment returns. And here's what I mean. If you invest your money under your personal name, any income your investments generates could be taxed at anywhere between 30% to 45% depending on your marginal tax rate. But if you invest through your super fund, those same returns are only taxed at 15%. And when you retire, this could even drop to 0%. Now, this difference might not seem huge at first, but let's put it in perspective. Say you're currently 55 years old and planning to retire when you're around 60 years old or older, and you've already got personal investments generating around $50,000 a year in passive income in your personal name. You've also managed to save an extra $500,000 that you want to invest. If you invest that $500,000 at 5% annual return, that's a $25,000 in extra passive income per year. With compounding, that annual income would grow to about $38,700 per year after 10 years. So if you hold this investment personally in your personal name, you could easily pay between 30 to 45% tax on that income. That's potentially over $17,000 each year in taxes alone. But if you pay that same amount, $500,000 into your super fund as a non-concessional contribution and then invest it through super, your investment returns could be taxed at just 15%, dropping down to 0% when you retire. That means you could potentially save over $17,000 in tax every single year just by structuring your investment into your super fund. This strategy is especially beneficial if you're looking at positively geared investments like shares or property within SMSF. There are a few more ways you can even get more benefits out of your super. That's not just related to tax. For example, did you know that if you earn less than $60,400 per year and make a personal super contribution, the government will help you make a co-contribution of up to $500. The actual amount you receive depends on the income and the size of your personal super contribution. There are two income thresholds for co-contributions. The lower threshold, which is currently $45,400, and the higher threshold, which is currently $60,400 for 2024 and 2025. If your total income is equal to or less than the lower threshold, your maximum co-contribution is $500. When your total income is between the two thresholds, your maximum co-contribution reduces by 3 cents for every dollar you earn above the lower threshold, reaching 0 when the income reaches the higher threshold. You will receive 50% of co-contributions for each dollar of your personal contributions, up to maximum co-contribution determined by your total income. For example, if your maximum co-contribution is $500 and you contribute $1,000, you will receive a $500 co-contribution. If you instead contribute $400, you will receive $200 co-contribution. You also need to be able to prove that at least 10% of your total income must come from employment, carrying on a business, or a combination of both. This can be salary and wages, business income as a sole trader or partnership, and director fees. To make things easier, the ATO does everything for you when it comes to co-contribution payments. Once you lodge your annual tax return, it decides if you're eligible and automatically pays the correct amount into your super account, so you don't need to do anything. But because this is an after-tax contribution, you don't get an immediate tax deduction. But the benefit is that the money grows inside your super at a lower tax rate and eventually becomes tax-free when you retire. This is a great strategy for part-time workers, young professionals, and anyone earning under the threshold who wants an easy way to boost super without much effort. Another co-contribution scheme you might want to consider is if your spouse earns less than $40,000 per year and you can contribute to their super and receive a tax offset of up to $540. This is how it works. If you contribute at least $3,000 to your spouse's super, you can claim an 18% tax offset, which means you get $540 off your tax bill. If your spouse earns between $37K and $40K, you may still get a partial offset, but it reduces as the income increases. This strategy can be particularly useful if one partner is not working or earning a lower income, such as parents taking time off to care for children. Instead of just leaving super contributions to higher income earning spouses, this allows couples to boost the lower income partner's super while also getting a bit of a tax break. One more super benefit I'll mention is if you're saving for your first home, you can use up to $50,000 of voluntary super contributions to help with your deposit while also getting a tax benefit. Basically, you also have to make voluntary contributions to super, either concessional or non-concessional. And then when you're ready to buy your first home, you'll be allowed to take out up to $15,000 of your voluntary contributions from any one financial year, up to a total of $50,000 across multiple years, plus any earnings you made on that. So the tax benefit here is that if you've made concessional contributions, you're essentially saving on tax on your deposit savings. For example, let's say you earn a gross salary of $100,000 and commit to saving $200 per week for your first home deposit. You can do this either outside or inside of your super. This is how it would compare. You can see that you'll be able to save an extra $1,560 towards your deposit. So at the start of this, I asked you when the last time was that you actually looked at your super. But now you know that super isn't just about retirement. You might want to have a look at your super contributions and see if there's a better way to structure them. Maybe salary sacrifice makes sense. Maybe a personal deductible contributions could lower your taxable income. Or maybe there's a government incentive you didn't realize you were eligible for. None of these changes require huge effort, but over time they can make a big difference. I'll see you guys next time.